Hello CFA aspirant. In this video, we will discuss the practice questions of reading number 36, Overview of Equity Securities. The key to get success in CFA Level 1 exam is practice, practice and more practice. As it is said that the more you sweat in training, the less you bleed in war. Same goes in CFA preparation. The more you practice, more will be your confidence on the day of exam, less will be your chances of not clearing the exam. So guys, make sure you can do as much practice as you can. Now coming back to reading number 36, overview of equity securities, I will advise you can pause this video first and try to solve questions on your own. Once you are done, you can resume this video and cross check whether your answer is correct or incorrect. The more important part for you is to cross check your thought process. You must cross check what was your thought process while selecting a particular option out of A, B and C. I will try to give the rationale behind every option in the question. So let's start with very first question. Now the very first question says, which of the following is not a characteristics of common equity? You need to focus on the wordings. We need to find out which of the option is not a feature or which of the option is not a characteristic of common equity. Option A, it represent ownership interest in the company. So clearly this is one of the feature, this is one of the characteristic of common equity. So as a company, let's say company is issuing 100 shares, okay, 100 equity shares, and as a shareholder, let's say you bought 10 shares. So you become 10% owner in the company. Out of 100, even if you buy one share, still you become the owner. Okay, now here you are 1% owner in the company. So clearly equity represent ownership. So option A cannot be the answer. Now let's focus on option B. Option B says shareholder participate in decision making process. Yes, this is true. Shareholders do participate in decision making process with the help of voting rights. So I can see option B is also one of the feature. So this cannot be the answer. So what left is option C. Option C will be the correct choice. But let's read out what option C says. Option C says the company is obligated to make periodic dividend payment. This is not correct. See, when company is issuing equity instrument, company is under no obligation to pay periodic dividend payments. When company issue debt, then only company is obligated to pay interest until the debt is retired. So option C is not looking a feature of common equity. That's why option C is the correct choice over here. Second question, the type of equity voting right that grants one vote for each share of equity is referred to as what? So focus on the wording. We need to figure out type of equity voting right. So we have two types of equity voting right. One is statutory and second one is cumulative. So option A says proxy voting. This cannot be the answer. See, proxy voting is one of the concept you can understand in this way. As a shareholder, for some reason, let's say you cannot participate in decision making process. You cannot visit to cast your vote. So what you can do as a shareholder, you can send some other person on your behalf. So this is the concept called proxy voting. So this is not the type of equity voting, right? So option A cannot be the correct choice. Option B, statutory voting. Yes, this is the correct choice. See, in statutory voting, one share is equal to one vote. So as a shareholder, let's say you have 100 shares with you. So you have total 100 votes with you. So this is what we have to figure out here. Okay, the type of equity voting that grants one vote for each share of equity. So yes, option B is the correct choice, statutory voting. Let's look at the option C. Option C is cumulative voting. So again, this cannot be the answer. Now let's understand how cumulative voting system works. See, in cumulative voting system, one share is not equal to one vote. Okay, you need to remember. In cumulative voting, what you need to do, total voting rights are based on the number of shares owned multiplied by number of board of directors being elected. So I will quickly write down for you. In cumulative voting, total voting rights total voting rights are based on the number of shares owned, okay, number of shares owned multiplied by number of board of directors being elected. Okay, now let's understand with the help of example. So let's say as a shareholder you own 100 shares with you, and there are total 4 board of directors to be elected. Now how many total votes you have? Now you have total 400 votes with you. Now as a shareholder you can cast either all 400 votes in favor of single candidate, or you can spread them across the candidate in any proportion. So this is how cumulative voting system works. Now this cumulative voting is often used in order to better serve shareholders who own small number of shares. Okay, so I hope this is clear with you. Option B is the correct choice, statutory voting. In statutory voting we have 1 share which is equal to 1 vote. Question 3. All of the following are characteristics of preference shares except. So we need to figure out which of the option is not looking like a feature or characteristic of preference shares. So let's read out option A. Option A says they are either callable or puttable. No, this is not the feature, this is the correct answer. See, preference shares can be issued without call and put option. So preference shares do not have to be either callable or puttable. Preference shares can be issued without call option, without put option. So this is clearly not the feature of preference share. Now let's read out option B. Option B says they generally do not have voting rights. True. Only equity shares have voting rights. Preference shares do not have voting rights. Option C says they do not share in operating performance of the company. True. See, preference shareholders are entitled to receive dividends. They are not eligible to share in the operating performance of the company. They are only entitled to receive fixed dividend. Now again, just like equity share, under preference shares also, firms are not under any contractual obligation to pay periodic dividends even to preference shareholders also. Okay, you need to remember this point. So option A is not the feature of preference share, hence option A is the correct choice in this question. Question number 4. Participating preference shares entitle shareholders to what? So focus on the wording. We need to focus on participating preference shares. Okay, so your thought process should be from participating preference shareholder point of view. So option A says they are entitled to participate in decision making process of the company. False. See, only equity shareholders are allowed to participate in decision making process of the company with the help of voting rights. Preference shareholders do not have voting rights, so clearly answer A is not the correct choice. Option B says they are entitled to convert their share into specified number of common shares or equity share. Again, false. If preference shareholders can convert their share into equity share, then this is known as convertible preference share. But this question number 4 is all about participating preference shares. Hence, option B is also not the correct choice. So option C is the correct choice. Let's read option C. What option C says? Option C says they receive an additional dividend if company's profit exceed a predetermined level. So yes, this is correct. See, participating preference shareholders are entitled to receive standard preference dividend plus the opportunity to receive an additional dividend if company's profit exceed a pre-specified level. Okay, this is the condition you need to remember. If company's profit exceed a predetermined level, then only they are eligible to receive extra dividend. So hence option C is the correct choice. Question number 5. Which of the following statements about private equity securities is incorrect? So focus on the word private equity and we need to figure out which option is not correct. So option A, they cannot be sold on secondary market. True. Okay, this is the true option. Private equity securities do not have active secondary market, so they cannot be sold on secondary market. Hence option A is the correct choice. Option B, they have a market determined quoted price. False. Okay, this is not correct. Again, the explanation is same just like option A. Just now I told you private equity securities, do not have active secondary market. Hence, they do not have, market quoted price. But here it is mentioned they have market quoted price. Hence, this is false, and this is what we need to figure out. Incorrect option. Let's read out option C. They are primarily issued to institutional investors. So this is correct. Private equity securities are issued primarily to institutional investors via non-public offerings such as private placement. So option A, option C are true, correct choices, and option B is incorrect option, false option. Hence option B is the correct answer for question 5. Question number 6, venture capital investments. Okay, so this question 6 is all about venture capital. Option A, it is saying that it can be publicly traded. Okay, so this is false. See, venture capital is type of private equity, hence it cannot be publicly traded. So clearly option A is incorrect. Option B says do not require long-term commitment of funds. Do not require. So this is again false. See, under venture capital, under venture capital, the opportunity to exit the investment is typically within 3 to 10 years from initial startup. So clearly they do require long-term commitment of funds. So this is also false. Option C, this will be the correct. Option C says it provide mezzanine financing to early stage companies. So this is completely true. Venture capital investments provide seed or startup capital, early stage financing or mezzanine financings to companies that are in early stages of development. So hence option C is correct answer. Question number 7. Which of the following statements most accurately describe one difference between private and public equity firm? So here we need to find out the difference between a private and public equity firm. Option A says private equity firms are focused more on short-term results than public firms. So this is completely false. This is not the true. See, in operating a public traded company, management often feel pressured to focus on short-term results like meeting quarterly sales and earnings target. So this is true for public firm, not for private firm. By going private, management can adopt a more long-term focus. So clearly option A is incorrect. Let's read out option B. Option B says private equity firms' regulatory and investor relation operations are less costly than those of public firms. So this is true. This is completely true. See, by going private, management can adopt more long-term focus. This is point 1. Second, management can eliminate certain costs that are necessary to operate a publicly traded company. So take for example, cost of meeting regulatory and stock exchange filing requirement, cost of maintaining investor relation department to communicate with shareholder and media. So these costs can be completely avoided by going private. So hence option B is looking correct option here. This is true. Now let's read out option C. Option C says private equity firms are incentivized to be more open with investor about governance and compensation than public firm. This is again false. See, option C is true from public firm point of view. Not from private firm point of view. Public firms are listed on stock exchange, so they are under public scrutiny. So by operating under public scrutiny, companies are incentivized to be more open in terms of corporate governance. So option C is also incorrect. Hence option B is correct choice here. Question number 8. Emerging markets have benefited from recent trends in international markets. Which of the following has not been benefit of these trends? So we need to find out which is the incorrect option out of A, B and C. Which of the following has not been benefit of these trends? A, emerging markets companies do not have to worry about lack of liquidity in their home equity markets. True. This is the correct statement. Emerging markets companies have found it easier to raise capital in markets of developed countries. So this is also true. So option C is the correct answer. Let's read out what is option C. Emerging markets companies have benefited from stability of foreign exchange market. No, this is not the case. Okay, emerging markets companies have not got foreign exchange stability benefit. See here, you need to understand over the past 2 decades. Okay, over the past two decades, the trend has emerged. And what is this trend? The trend is increasing number of companies are dual listed, which means that their shares are simultaneously issued and traded in 2 or more markets. So companies located in emerging markets have particularly benefit from this trend, because they no longer have to be concerned with capital constraint or lack of liquidity in their domestic markets. Why so? Because companies have found it very easier to raise capital in markets of developed countries, because these markets generally have higher level of liquidity and more stringent financial reporting requirement. So that's why option A and option B are correct statements and option C is incorrect. So option C is the answer over here. Question number 9. When investing in unsponsored depository receipt, the voting rights to the shares in the trust belong to option A, depository bank. So this is the correct option. Okay, this is true. Now let's understand. Okay, focus on the word unsponsored depository receipt. Okay, so your thought process should be from unsponsored DR. See, a DR can be sponsored depository receipt or unsponsored depository receipt. A sponsored DR is when foreign company whose shares are held by depository has direct involvement in the issuance of receipt. Investors in sponsored DR have the same right as the direct owners of the common shares. Whereas in unsponsored DR, the underlying foreign company has no involvement at all with the issuance of receipt. Instead, the depository purchases the foreign company's shares. Hence, depository retain voting rights, not the investors. So that's why when it is unsponsored DR, you need to remember voting rights are with depository, and when we have a sponsored DR, then voting rights are with investors. So option A is the correct choice over here. Question number 10. With respect to level 3 sponsored ADR, which of the following is least likely to be accurate? So focus on the word level 3 sponsored ADR and we need to answer least likely statement. So option A, they have low listing fees. Okay, this is false, so this is the correct answer. Let's read out option B. They are traded on NYSE, NASDAQ and Amex. So this is true. Level 3 ADRs are listed on stock exchange and these ADRs are traded at NYSE, NASDAQ, Amex. So this is correct statement. Option C, they are used to raise equity capital in US market. So this is also true. Now why option A is false? Because see, as these level 3 ADRs are listed, so they have high listing fees. So listing fees cannot be low. Listing fees has to be high. So that's why option A is correct answer here. This is incorrect statement. Question number 11. A basket of listed depository receipt or an exchange traded fund would most likely to be used for. So here you need to focus on basket of listed depository receipt. So this is nothing but it is BLDR. Now what is BLDR? BLDR is nothing but it is an exchange traded fund. Okay, so we need to answer BLDR is most likely is used for what? Option A, gaining exposure to single equity, false. Hedging exposure to single equity, false. Gaining exposure to multiple equities, this is true. See, BLDR is an ETF that represent a portfolio of depository receipt. Okay, so focus on the word portfolio. As it represents the portfolio of depository receipt, hence it is used for gaining exposure to multiple equities. Okay, not to a single equity, and it is not used for hedging exposure. So that's why A, B are incorrect. Option C is true statement over here. Question number 12. Calculate total return on a share of equity using the following data. So focus on the word total return. Okay, we need to calculate a total return from the following information. Purchase price is given $50. Sell price is $42. Dividend paid during holding period is $2. Now focus on the word total return. Total return means we need to include dividend information. And to calculate returns, to calculate returns, especially holding period return, you can use this formula: ending value divided by beginning value minus 1 into 100. Now this ending value also include the information about dividend. So ending value is nothing but a current price, you can say, so which is $42. So here I will write $42. As I told you, this will also include the information about dividend. Dividend is $2 divided by beginning value. Beginning value is nothing but your initial value or your purchase price, which is 50. So minus 1 into 100. When you solve this, when you do this calculation, okay, 44 divided by 50 minus 1 into 100, you will get answer negative, okay, 12%. Hence option A is correct choice. Question number 13. If US based investor purchase a euro denominated ETF and euro subsequently depreciate in value relative to the dollar, the investor will have total returns. That is, so first try to understand this equation. So this is a clear case of foreign investment. Here you can see the investor is from US, okay, US based investor. He purchases euro denominated ETF. Okay, so this is a clear case of foreign investment. And what happened after his purchase? What happened? Euro depreciate. So if the currency depreciated in which we have invested, so obviously you will have a negative returns. And if currency is appreciated in which you have invested, then obviously you will have positive return. So let's read out the option. What will happen to this investment? So option A is saying he will have lower return than the ETF total return. So this is looking good. This is true statement. Option B is completely false. Okay, because here it is written higher than ETF. His returns cannot be higher than, because the currency in which we have invested is depreciated. So his return cannot be higher. C, the same as ETF total return. So this would be true if it was the case of domestic investment, you can say, because in domestic investment we don't have to look for currency, right? What happened to the currency? So option C is also false. So option A is correct statement over here. Question number 14. Which of the following is incorrect about the risk of an equity security? The risk of equity security is what? Okay, so focus on the word incorrect and we need to think from risk point of view. Okay, risk of an equity security. So option A says it is based on uncertainty of its cash flow. This is looking good. This is true, because equity instrument have unpredictable cash flow. We cannot predict cash flow with certainty, because many companies do not give dividends to equity shareholders, as firms are under no contractual obligation to pay dividends. So hence it is very difficult to predict cash flow with certainty. So option A is looking good. So this add the risk element. Option B, based on the uncertainty of future price. This is also true, because we cannot predict what will be the future price again with certainty, because future price depend on investors expectation about performance of a company. So again, as an analyst or as an investor, we cannot predict what will be the future equity price with certainty. So A, B are two statement. So option C will be the answer. Let's read out why option C is incorrect. Option C is saying measured using the standard deviation of its dividends. No, this is completely incorrect, because dividends, as I told you, firms are under no contractual obligation to pay dividends. So some companies may pay dividends, some companies may not pay dividends. So we cannot use standard deviation of dividend in this case. So therefore option C is incorrect statement. Question number 15. From the investor's point of view, which of the following equity securities is least risky? Okay, focus on investor's point of view. Which equity security is least risky? Okay, so option A, puttable preference shares. Option B, callable preference shares. Option C, non-callable preference shares. So option A is the correct answer. Okay, this is the true statement. Puttable preference shares have least risk compared to callable preference shares and non-callable preference shares. Let's understand why. See, when it comes to puttable shares, okay, no matter if they are equity shares with put option or preference shares with put option. With puttable shares, investor retain the right. Okay, investor has option to sell the shares back to the issuer at predetermined price. So let's say in putable preference shares, okay, investor has a right to sell the shares back to the company if price drop below $70. Now as soon as price goes below $70, as soon as price goes below $70, what investors will do? Investors will sell their preference shares back to the company. So this predetermined price creates a floor for the share price that reduce the uncertainty of future cash flow. So this do not happen with callable and non-callable preference shares. See, in callable preference shares, issuer has the right to call the share, and in non-callable preference shares, okay, neither issuer nor investor has the right. So compared to callable and non-callable, putable preference shares are more safe to invest. Question number 16. Which of the following is least likely to be a reason for company to issue equity securities on the primary market? So focus on the wording. We need to figure out least likely statement. Option A, to raise capital. Option B, to increase liquidity. Option C, to increase ROE. So option C is correct option. Okay, this is least accurate. Company do not issue equity shares to increase ROE. So company issues equity securities on primary market to increase capital and to increase liquidity. The additional liquidity also provide corporation an additional currency which it can use to make acquisition and provide stock option based incentives to employees. So yes, company issue equity securities in order to raise capital and in order to increase liquidity. Option A, option B, both are correct. Option C is incorrect. Question number 17. Which of the following is not a primary goal of raising equity capital? So focus on the wordings. We need to figure out which of the following is not a primary goal. Option A, to finance the purchase of long-lived asset. Option B, to finance the company's revenue generating activities. And option C, to ensure the company continue as a going concern. So incorrect option is option C. See, option A and option B are correct option. The primary goal of raising capital is to finance the company's revenue generating activity in order to increase net income and to maximize the wealth of shareholder. Now in most cases, the capital which is raised is used to finance long-lived asset. So therefore option A, option B are correct option. Option C is incorrect option. Alternatively, a company may be forced to raise capital to ensure that it continues to operate as a going concern. In these cases, capital is raised to fulfill regulatory requirement, improve capital adequacy ratio, or to ensure the debt covenants are met. So in such cases, company has to raise capital to ensure it continue as a going concern. So this cannot be the primary goal, whereas option A, option B are primary goal of raising equity. Question number 18. Which of the following statement is most accurate in describing company's book value? So we need to figure out most accurate statement about book value. Option A, book value increases when company retain its net income. This is looking good. Let's read out option B and C. Option B, book value is usually equal to company's market value. No, book value is seldom equal to market value, meaning book value and market value both are rarely equal. So option B is incorrect. Option C, the ultimate goal of management is to maximize book value. No, the ultimate goal of management is to increase book value, not to maximize book value. So option C is also incorrect. So option A is correct option. Book value increases when company retain its net income. So what is book value? Book value is nothing but asset minus liability. Now asset minus liability is nothing but equity capital. In other words, you can also call this as a book value. Now when company retain its net income, it is transferred to equity as a surplus. So your equity will increase when company retain its net income. So option A is correct. Question number 19. Calculate the book value of company using following information. So data is given. In previous question number 18, we have discussed book value is nothing but asset minus liability. So here you can see asset is given, liabilities are given. So you can perform this basic calculation. So assets, I can see it is 12 million minus 75 lakh or 7.5 million. So 12 million minus 7.5 million, it will be 4.5 million, right? So option A is correct answer here. Question number 20. Which of the following statement is least accurate in describing company's market value? So focus on the wording. Least accurate statement we have to figure out about market value. Option A, management decision do not influence the company's market value. Option B, increase in book value may not be reflected in company's market value. This is looking true. Option C, market value reflects the collective and differing expectation of investors. This is also looking true. Now option B and option C are true statement. Option A is incorrect. Let's try to understand the logic. So let's first understand what market value is. See, the market value of company's equity reflect collective and differing expectation of investors concerning the amount, timing and uncertainty of company's future cash flow. So therefore option C is correct. Now why option B is correct? See, option B is correct because increase in book value is not reflected in company's market value. Why so? Because management may be accomplishing its objective of increasing the company's book value. This increase may not be reflected in market value of company's equity because it does not affect investors' expectation about company's future cash flow. So therefore B and C are correct. However, option A is looking incorrect. Management decision do not influence the market value. It does influence the market value. Indirectly, it influences the market value. See, management decision will directly influence the book value. If it influences the book value, it will influence the market value as well indirectly. So therefore option A is correct answer for this question. Question number 22. Holding all other factors constant, which of the following situation will most likely lead to increase in company's ROE? So which statement will lead to rise or increase in ROE? This we need to find out. See, return on equity formula is net income divided by equity capital. Now let's read out option A. Option A is the market price of company's shares increase. See, market price nothing has to do with ROE. So option A cannot be the answer. Option B, net income increases at a slower rate than shareholders' equity. This means shareholders' equity is increasing at a faster rate. If denominator increases, return on equity will decrease. So option B is also not correct. Option C, the company issues debt to repurchase outstanding shares of equity. This is looking good. See, return on equity is net income divided by equity capital. Now when company repurchase or buy back its equity, so denominator will decrease, and if denominator decreases, return on equity will increase. So option C is correct choice. Question number 23. Which of the following measure is most difficult to estimate? Cost of debt, option A. Option B, cost of equity. Option C, investors required rate of return on debt. So option B is correct choice. Cost of equity is most difficult to estimate. Why so? Because see, the cost of equity is depend on investors required rate of return. Now every investor is different. So different investors have different risk levels and different expectations about company's future cash flow. So therefore cost of equity is very difficult to obtain with certainty. So therefore option B is correct choice. Question number 24. A company's cost of equity is often used as a proxy for investors. So focus on the word cost of equity. We need to figure out cost of equity is used as a proxy for what? Average required rate of return. Option B, minimum required rate of return. Option C, maximum required rate of return. So correct option is option B. Now why so? Because company tried to raise funds at the lowest possible cost. Therefore cost of equity is used as a proxy for minimum required rate of return, not for average, not for maximum required rate of return. That's it in this video. If you really like this video and explanation in every example, so you can like this video, you can subscribe to our channel, you can share this video to your friends, and if you want to see more such videos about different topics where I should discuss the practice question, you should mention in comment box so that we can prepare many more such videos. Thank you.